Qualitative characteristic 2 is faithful representation. So we're looking at the things that tell us how to prepare the reports. And our second one, Q2, is faithful representation. What does that mean? It's a bit wordy, but we'll try and summarize. It basically means the information that you report must be a faithful representation of the real-world economic event it represents. I guess what we're saying is what you report has actually got to reflect reality. It can't be made up. It's got to reflect what actually happened. What does that mean? It means that the information you present has got to be complete. So don't exclude things just because they might be bad. It's got to be free from error, so we can't have things that are wrong in there. And lastly, it's got to be neutral without bias. We're dealing with accounting here. It's the language of business. It's a neutral language. It's just numbers and data and fact and information. So it's got to be neutral without any sort of subjectivity in it. So how does that work? Well, let's go back to our accounting process. So we'll say the first thing that happens in the business is you have transactions. When you have transactions, there's source documents. So you make a sale, you pay some wages, you take out a loan, etc. Millions of these every year for every business. What's stage 2? Well, we've got to record that. So that's where we come in, the accounting and the accounting system. Then what? At the end of the period, we've got to do our reports. And we've got 3. Income statement, cash flow statement, balance sheet. And then the thing that, makes accounting actually really important and valuable is this 4th step. It's not this stuff here, the recording, that is valuable, but it's this. Can you analyze these reports and make good decisions? Who? Owners and investors, suppliers, banks and lenders, employees, etc., the government. That is what faithful representation is about. It's about this step here. So let's get rid of stage 1 and 2 and say it's all about making sure these people here can make really good decisions because they can trust the information that's in the income statement, the cash flow statement, and the balance sheet. And history is littered with examples of businesses that committed fraud and, made these figures look better by either including something or excluding something that shouldn't have gone in there, or just outright making estimates and making stuff up, that sort of thing. So what we want to do is we want to make sure that the information in these reports is correct. And that way the person using them can make informed decisions and most importantly, not be misled. How can you do that? Well, easy, just those 3 things. It's got to be complete. It's got to be free from material error. So we looked at what materiality was when we looked at relevance. And it's got to be neutral. So one last thing to consider is how can we do this? And throughout the course, we're going to be looking at what's called checking mechanisms. We won't really know what these are yet, but as we go through the course, we'll look at some of these. What is that? It's like a tool built into your accounting system to ensure all the transactions and reports have been recorded and prepared accurately, and it helps us identify any errors. So it's like so if you've done your accounting year 11 and you do your balance sheet at the end and it balances, that's a checking mechanism. You know you've got it right. If all the things in the asset side equal liabilities known as equity. So that's one checking mechanism. We're going to look at some others. So here's some examples we'll look at throughout the course. There's something called a trial balance, and that checks whether the general ledger balances. So the specific check is all your debits must equal all your credits, and we'll get to those later. Inventory cards. Each model of inventory has its own card, which records all sales and purchases, and what the check there is, the total of all these cards must equal the total of your inventory ledger. And we've got subsidiary records, so each account receivable and payable has its own record, and the total of those must equal that specific account ledger. Now, these won't mean anything to us. You might never know what we're talking about here at this point. What we want to do is come back at the end of the course and look at these things. These things should make sense. And these are checking mechanisms to make sure there's no errors. We've got one more. We're going to look at it in a separate video. It's a hidden little topic that sometimes a lot of the textbooks don't have, but it pops up on the exam. It's called internal control. And that's procedures and safeguards to protect the assets of the business. So we'll make a separate video about that to talk about it later. But these things here, these are all checking mechanisms. And what are they about? They're making sure that the information we present is a faithful representation of what actually happened.